good morning, Trinidad and Tobago, and welcome to the Bourse Report. Well, as mentioned, today we're taking a look at equity markets and equity market update, as it were, for the first 9 months of 2023. Let's take a look at what performances would have occurred, what might be some of the major drivers, particularly on the local exchange or the local stock exchange, and what investors might expect in the coming, the remainder of 2023, rather. So let's turn firstly to that local outlook or the local performance. And when we take a look at some of the indices, we can see it's not very good reading for locally oriented investors, or that portion of your investment portfolio that may have some exposure to local equities. The All Trinidad and Tobago Index, for example, has been down or was down 7.7% for that first 9-month period of 2023. The cross-listed index overall also, which includes some of our foreign domicile but locally listed or cross-listed companies such as Grace Kennedy, NCB Financial Group, Guardian Holdings, Massey, and a couple others, would also have declined just about 14.5%. Overall, that Trinidad and Tobago Composite Index down just about 9.2% as at the three-quarter way mark, or at the end of September 2023. And the Caribbean Exchange, which takes a even broader look at regional equity performance, down just about 6% as well. So reflecting certainly some challenges, or lower investor sentiment rather, across the region at an aggregate level. Now, when we take a look at specific major movers on the Trinidad and Tobago Stock Exchange, it was indeed a mixed bag. On the outperformers or the best performers, the top 5 performers for that 9-month period, we can see Agostini's Limited up 86% again on the heels of stronger earnings growth, as well as continued acquisition activity and regional diversification. First Caribbean International Bank up 28% driven by higher interest rates, U.S. interest rates rather, which would have led to improving interest income overall and increased earnings for the banking group, the Canadian-owned banking group. Prestige Holdings Limited up 27% on the heels of increased revenues and profitability. Again, no more store closures or restaurant closures rather due to COVID or any other similar features. So that would have certainly filtered through into improved performance for Prestige Holdings. And OCM and Antimacal up 12 and 12.4% respectively, with some improving earnings for Antimacal and some recovery in share price for OCM after a couple of challenging periods with share price performance. On the other end of the scale, we can see that there were some fairly major names on the worst performers of the Trinidad and Tobago Stock Exchange. Guardian Holdings Limited down 29%. Somewhat oddly given generally improving performance, but again, the implementation of new insurance IFRS standards creating some uncertainty in the minds of investors. Guardian Media Limited down just about 32%. NCB Financial Group down 39% with some uncertainty being created given the very wide movement in terms of changes at the leadership level of NCB, and certainly the return of its majority shareholder, the Honorable Michael Lee-Chin, back into the fray to try to ride the ship of NCB Financial Group going forward. NGL down 44% given some of the movements in energy markets and certainly the muted domestic energy production outlook. And Whitco down 51% year to date, given that continued revenue challenges as well as operating margins starting to narrow a bit for the group. When we take a look at U.S. markets, we can see that it was broadly positive. The S&P is up 11.7% at the 9-month 2023 mark, driven by improvements in the communication services sector, technology, and consumer discretionary sectors, as well as financials. On the other end of the scale, we see that consumer staples, real estate, and utilities are some of the worst performing sectors in the U.S. markets, and that is somewhat not very surprising given that real estate and utilities have been focused on for their income generating capacity, and with interest rates at the high end, particularly for U.S. Treasuries, where 2-year Treasuries can yield you in excess of 5%, for example. Real estate and utilities for their dividend or cash flow properties have become a little bit less relatively attractive in the current interest rate environment. At a broader international level, we can see that stocks were also pretty much up. Europe For example, at that 9-month mark of 2023, up 6% in US dollar terms. Latin America as well, up 8.1%. So investors seeming to climb continuing walls of worry and be somewhat cautiously optimistic, placing some continued faith in equities at the international level, with the exception of Asia ex-Japan, which is down 2.7% in US dollar terms, again, with continued geopolitical tensions, particularly between China and the West, causing some concerns, as well as slowdowns or perceived slowdowns in China's economic activity. Now, what can investors expect for the remainder of 2023 being market drivers? Well, at the local level, we'll be looking at continued cooling inflation, and inflation has certainly turned the corner based on available data and is heading in the right direction, which is, of course, lower. We see that despite weak investor sentiment in the local and regional stock markets, there is that degree of resilient earnings being posted by some of the bellwether or blue chip stocks. But of course, that energy production outlook, which is one that is focused on stabilization on the near term, and really not much in terms of increased energy production, which is one of the major drivers of the local economy, is going to continue to weigh a bit on investor sentiment in the very near term. Internationally, we can expect, again, cooling U.S. inflation to be a theme, which could drive interest rate expectations going into the end of 2023 and 2024. Strong corporate earnings, again, a feature at the international level as well. But keeping an eye on those geopolitical tensions, which continue to increase and broaden, certainly in terms of military standoffs at the international level. We have the Russia-Ukraine situation ongoing, as well as the now developing Israel-Hamas situation. And again, that is causing or drawing a line in the sand and causing persons to take sides. And that could, of course, lead to increased market volatility. So for equity markets, some positives, some negatives, again, remain diversified. And of course, look for the clear opportunities in terms of attractive valuations, much of which seems to be in the local market for those of us who may be having a longer-term investment horizon and looking for bargains. And of course, for this and more information, you can give us a call at 226-8773 or to Bourse, email us at invest@boursefinancial.com. And of course, you can check out our website, bourseinvestment.com, where all of our research is absolutely free. And catch this article in today's business section of the Trinidad and Tobago Guardian newspaper. Until next time, stay safe, keep investing, and we'll see you on the Bourse Report.